price tells you what happened. The accumulation distribution line tells you who is behind it. Developed by Mark Chaikin, this volume-based indicator reveals whether institutions are quietly building positions or unloading inventory beneath the surface. In the next few minutes, we'll dissect the math, the signals, the divergences, and the traps that even experienced traders fall into. Think of the A/D line like watching a tide pool fill and drain. The waves are price action, loud and obvious, but the actual water level rising or falling tells you whether the tide is genuinely coming in. A big crashing wave that leaves the pool emptier than before is distribution. Quiet ripples that steadily raise the water line are accumulation. The A/D line ignores the drama of the waves and measures the water level itself. Here's the engine. For each bar, calculate the money flow multiplier, close minus low, minus high minus close, all divided by high minus low. That value ranges from -1 to +1, and it tells you where the close landed inside the bar's range. Multiply by volume to get the money flow volume. Then accumulate that running total. Closes near the high with heavy volume push the line up. Closes near the low push it down. Closes in the middle contribute almost nothing, regardless of how loud the volume was. In a healthy uptrend, the A/D line should be making higher highs alongside price. That confirms buyers are consistently closing bars in the upper portion of their ranges on real volume. In a downtrend, the line should carve lower lows. When the A/D line and price agree, you have institutional confirmation. The slope matters more than the absolute value because the starting point of the cumulative sum is arbitrary. This is where the A/D line earns its keep. Price prints a lower low, but the A/D line refuses to follow, carving a higher low instead. That tells you sellers are exhausted. Volume is flowing in on dips and closes are creeping back toward the highs. This is classic accumulation behavior, the footprint of bigger hands buying weakness. The reverse pattern, price making higher highs while the A/D line rolls over, is bearish divergence and often precedes distribution tops. Here's a concrete setup on a synthetic chart. Price has been grinding down for 3 weeks into a support zone. On the final flush, price prints a new low, but the A/D line has held its prior low and is curling up. Your trigger is a reclaim of the previous swing low as new support, confirmed by the A/D line breaking above its short-term downtrend. Entry goes on the close of that reclaim bar. Stop sits just below the absolute price low. The signal fails if price closes back below that low, while the A/D line also breaks down, invalidating the divergence. Now let's pressure test this on real data. Look at SPY on the daily time frame. You can see periods where the A/D line either confirms a price breakout or quietly diverges before a correction. Notice how the line tends to telegraph distribution before the indices roll over, with the cumulative flow flattening even as headlines stay bullish. Train your eye to compare the slopes side by side, not the absolute levels. Strengths first. The A/D line incorporates both volume and the closing location, giving you a richer picture than price or volume alone. It's excellent for divergence work and confirming breakouts. Now the warts. It ignores gaps entirely because the formula is bound to each bar's own range, so a stock that gaps down and closes at the high of the day actually adds to accumulation, which can be misleading. It also lags during sharp regime changes, and on illiquid names the volume input is noisy and unreliable. The A/D line shines when stacked with other signals. Pair it with a Chaikin oscillator, which is the MACD of the A/D line, to time the inflection more precisely. Overlay support and resistance zones so your divergences trigger at meaningful price levels, not in the middle of nowhere. Combine with a trend filter like the 200-day moving average so you're taking bullish divergences in uptrending markets and bearish ones in downtrends. And confirm with relative volume to make sure the flow you're reading is statistically significant. 3 traps to avoid. First, anchoring on the absolute value. The line's starting point depends on when your chart loads, so only slope and relative highs and lows matter. Second, ignoring the gap blind spot. After earnings gaps, sanity check with on balance volume, which does respect gaps. Third, forcing divergences. A 2-day divergence on a 5-minute chart is noise. Use divergences on swings that have at least 10 to 20 bars of separation, and ideally on daily or higher timeframes for position trades. To recap, The/D line accumulates volume weighted by where the bar closed inside its range, giving you a footprint of accumulation or distribution. Trade the slope, hunt divergences at meaningful levels, combine with trend filters and volume confirmation, and respect its blind spot around gaps. Tomorrow, pull up 3 names on your watch list, plot the/D line on daily charts, and compare its slope to price over the last 60 days. You'll be surprised what's hiding in plain sight. This is education, not financial advice. Trade your own plan, manage your risk, and I'll see you in the next one. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.